Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello and welcome to Reverse Mortgage Radio. I'm very glad you guys could join me today. We've got some interesting topics we're going to talk about today. And, well, let me explain real quick here. We're going to talk about different product options. That's the term that the industry uses, but it's just one product with different options within that product. And what I'm talking about, obviously, is the FHA insured reverse mortgage program. The name of that program is called the Home Equity Conversion Mortgage. HECM is what the acronym is. HECM is what we call it. And there's different options within it. There's different ways you could take the money, and depending on which options you choose for interest rates, that kind of dictates the options that you have for drawing the money out. So it's really not that complicated, but depending on how you choose to set it up. All right. So we're going to get into that because there's three different interest rate options with reverse mortgages. There's the fixed interest rate, a monthly adjustable interest rate, and an annually adjustable interest rate. However, before we get into all the weeds on those different interest rate options and the different payout options that each one allows, I need to explain, too, for those of you that may not know, what a reverse mortgage is. I'm talking about FHA reverse mortgages here because if we get into proprietary reverse mortgages, those are non-FHA reverse mortgages, then it just is too big of a too broad of a topic to dissect here in the next 28 minutes. So what we're going to focus on the FHA insured reverse mortgage program, which is called the Home Equity Conversion Mortgage. And in a nutshell, that's a loan where you can take out money from the equity of your home and you never have to actually repay it yourself. It's an FHA insured loan that's specifically designed for people that are 62 and over. It allows you to convert some of the value of your home into money that you can then spend, because you can't spend your equity unless you convert it to cash first, right? And as long as you or your spouse or whoever is on title to the house is living in the home there with you and they're a borrower, then you can continue to live there as long as you pay your property taxes, you pay your homeowner's insurance, you maintain the home, keep your name on title, and live there as your primary residence. As long as you do those 5 things, no payment is ever due, and you can never, ever, ever be kicked out of the home. It doesn't matter what the value drops to. If the value were to drop, it doesn't matter what the loan balance grows to, because the thing about reverse mortgages is it's not free money. It's still your house, but it is a loan. And what do you do on loans? Normally you pay interest. Now, with a reverse mortgage, you don't have to pay anything to the lender. You have to pay for your taxes and insurance because the house is still yours, but you're still charged interest every month. You're charged interest and mortgage insurance on a monthly basis. And that interest and mortgage insurance gets added to the loan balance. If you take out $100,000 today, a year from now, you might owe $107,500 in that range. Who knows exactly, depending on how you use the money. If you take out more money after you take the initial 100, then your balance is going to be up. If the interest rate drops, then the amount you owe will also come down a little bit too. From that 107, it might be 106 or 105 or whatever. It could go up to 108. Just depends on what happens with the interest rate if you choose the adjustable interest rate. But it doesn't mean that you have to pay that money back right away. The loan only comes due when the last homeowner permanently leaves the home. Or if you fail to pay your property taxes or insurance or live there as your primary residence, or you take your name off title. If you do any of those things, that's called a maturity event, and that will cause the loan to come due. And that means that the entire balance has to be paid. It doesn't mean you can start making payments. We don't accept payments once the loan is due. We do accept payments while you're living there. You can make payments on the loan. So if you took out that $100,000 today and you're still working, you just took it out to pay off an existing mortgage to save yourself some money from making that payment, but you can pay, instead of $1,200 a month, you can pay $500 a month. You can do that if you wanted to. Or if you had an inheritance of $50,000, you can apply that $50,000 towards your loan balance with a reverse mortgage. And then if you choose a certain option, which we'll get into here in a minute, that money would then be available to you at a later date. But it's not if you choose a different interest rate option, okay? So we're going to get into these different things. However, I also need to explain kind of a quirky rule with reverse mortgages. It's called the initial disbursement limit. When you take out a reverse mortgage loan, let's say you own your home free and clear, and we can loan you $200,000. FHA says, yeah, we're going to make $200,000 available to you, but you can only take out 60% of that money in the first 12 months of the loan. That's called the initial disbursement limit. Sometimes I'll have people call me. They'll say, yeah, I've got this $1 million home and I want to take money out and buy a home in Arizona for $300,000 or $400,000. Well, maybe the total loan is only $400,000 and we can only offer 60% of that money available in the first 12 months of the loan. 60% of $400,000 is $240,000. That's all you could take out in the first year of the loan. So then I have to explain to people that, yeah, you have all this money available to you, but you don't have access to it all at once. And that dates back to problems that we had in 2005, 6, 7, 8, 9 with people taking all the money out in one lump sum and then getting themselves in trouble. They blow the money, or their kids needed it, and so they helped out family members, and then they didn't end up paying the taxes and insurance, and they didn't have the reserves to pay the taxes and insurance. And we found as an industry that if we limit that, and also too, it's education, making sure people understand their responsibilities more so now than we did back then, that you do have to pay your property taxes and homeowners insurance and live there as your primary residence. All the rules. Those are the rules you have to abide by once you have the loan. But we weren't as good as an industry about making sure people understood that then. But these people would take out $100,000, $200,000, and they would blow it within 2 or 3 years, and then they couldn't pay their taxes and insurance. Back then, too, we did not have financial assessment, where we didn't qualify them, really. Are you old enough? Do you have enough equity? Then you qualified for a reverse mortgage. But in 2014, we instituted, actually, I think beginning in 2015, we started out with financial assessment, where we do have to make sure you have enough income to be able to afford to live in the home. So it's a sustainable solution for you, the reverse mortgages. By the way, my name is Bruce Simmons. My number is 303-467-7821. That's my direct line, 303-467-7821. That's my line. It rings right to me. You can call me with any questions. I'll answer the phone, or if I'm in a meeting, you can leave me a message and I will call you back. But I'm the reverse mortgage manager for American Liberty Mortgage here in Denver, and I've been specializing in reverse mortgages since 2003, January of 2003. So I'm going on 21 years now, or going on 22 years. I've been doing it over 21 years, specializing in this product. It's a great product, and I firmly believe it can help so many people who really need it and people who don't need it now, but they're looking at it from a financial planning aspect down the road. We've been getting more and more into that aspect of the industry too, helping financial advisors understand how this works, as well as real estate agents, home care professionals, attorneys, all these things that we're trying to get the word out that reverse mortgages are a legitimate financial planning tool. but it can also help people out right now. You got laid off, and you were planning on working till you're 70, and now you're only 64. You need to bridge that gap between 64 and 70 when you're planning on taking that Social Security. Reverse mortgage can help you with that. It can also help you out if you need to pay off an existing mortgage because now a spouse passed away, but you want to stay in the home, and you've got a mortgage that you can no longer afford. So those things are immediate needs that we can help with a reverse mortgage. But then once you decide that, yeah, I think a reverse mortgage would work for me, then you have to decide, well, what kind of interest rate option am I going to choose? Am I going to choose a fixed rate? That's what most people want. They say, yes, I need a fixed rate. Well, do you really? We're going to talk about that because the fixed rate, as you know, the interest rate never changes on the loan. It stays fixed for the entire life of the loan. A monthly adjustable interest rate is another option. And that one, the interest rate can and most often does change monthly, up or down. So if the interest rate's going up, your rate's going to go up the next month and the next month and the next month. But then when it comes down, and it drops usually quicker than it rises up until the last couple of years. But when it starts coming down, it comes down pretty quick. And you could take advantage of that because now you're at 7.5%. Next month you're at 7.25%, then 7. So it can drop just as fast as it rises. The annually adjusted rate, that's where the rate stays fixed for a year, and then it can change every year. But what we're going to do is we're going to dig into the pros and cons of these different products. Okay. First of all, the fixed rate. The fixed rate is a great option for some people. I know I did a loan for a guy where most people were doing adjustables, and he says, no. I need a fixed rate. Luckily, the interest rates were low. I think he locked his interest rate in the 3s back in 2021, I think was when we refinanced him. He bought his home in 2019. We did the loan for him on a fixed rate around 5%. And then the rates dropped, and we were able to drop his rate, but he had to refinance to take that rate drop. But now he's down at that really low rate. So he's got that benefit. Now the downside with the fixed rate is that you have to take all the money in one lump sum. Often you'll hear people talk about reverse mortgages saying, yeah, this is where the bank pays you instead of you paying the bank, and you can receive a monthly payment from the lender for the equity in your home, or you can set up a line of credit. I talk about that all the time. The benefits of the line of credit are tremendous on reverse mortgages, but it's not available with a fixed rate. You have to take all the money in one lump sum. Let's say you qualify for $200,000 on a reverse mortgage. You own your home free and clear. You can take out $200,000, or you have $200,000 available to you, and you tell me, Bruce, I am not even looking at an adjustable rate. All I want is a fixed rate. I'll say, okay, then the amount of money you have available is $120,000. That's all you could take out is 60% of what's available to you. So you have $60,000 available to you, but you can only take $120,000, and you have to take that all at one lump sum at closing. Say, well, wait a minute, I don't really need $120,000 right now. I own my home free and clear. I want to do some repairs on it that are going to only cost about $25,000. Well, then you really need to do an adjustable rate, because adjustable rates allow you to take out the amount of money you want. It provides much more flexibility. There is one caveat, one issue with the fixed rate that I want to explain, because this is a good way that you could use a fixed rate if you wanted to. Now, right now, nobody's doing fixed rates, because why lock in a 7 or 8% interest rate when you know the rates are going to be coming down? Now, they may come down and bounce back up. They may come down and stay down for a while. I don't know. Anybody that tells you what the interest rates are going to do, like they know what they're going to do, I would run away fast. John Rush and I, his host on a show on KLZ radio, he and I have a little bet now, because I think rates are going to drop some, but they're going to bounce back up. And at the end of the year, I told him I think rates are going to be where they are now or higher at the end of the year. But in the meantime, I think they're going to come down. But trying to time the market, you say, okay, well, I'm going to wait till rates come down, and then I'm going to lock in that fixed rate. Wham, right there. Exactly. And it doesn't always work that way. trying to time the market, whether it's a stock market, the real estate market, or the interest rate market, that's a losing proposition. You're not going to be able to do that. But if you really want a fixed rate and you say, I don't want to give up 40% of the money that's available to me, another possibility, because see, what the rules say on a fixed rate reverse mortgage is that it says that you can we're running into the problem with that disbursement limit caps. So the government caps the amount of money that we can give you at closing, but they don't cap the amount of money that can be paid on your behalf. I'm getting a little in the weeds here, but basically we can sometimes, if you wanted us to and you had enough equity, we can set aside money to pay your property taxes and insurance for you. It works different than a traditional escrow on your regular mortgage, because what they do is you're making a payment, you send in $1,200 a month, they take $400 out and they apply it towards your escrow. The other $800 goes towards your interest and principal. Well, you're sending payments every month. We're not allowed to require a payment from you. So if you qualify for $200,000 on a reverse mortgage, depending upon your age and the interest rates and the amount of your property taxes and insurance, we take money away from that $200,000 and set it aside. And then we estimate how long we think you're going to live in the home. This is called a life expectancy set aside, LESA, or a LISA. Okay, LESA, life expectancy set aside. So let's say you're 68 years old. We think you might live in the home another 17 years. Okay, whatever that adds up to. We're going to take out 17 years plus 20% of your property taxes and insurance. And let's say that's $60,000. What we could do with the fixed rate reverse mortgage, you say, I really only want a fixed rate. And I'll take all of them. I'll take the $120,000, but I don't want to give up the other $80,000 that's available. Well, what if we took $60,000 of that extra money that's available and set it aside to pay your taxes and insurance on your behalf? So now you don't have to worry about paying your taxes and insurance. The lender will do it for you on your behalf until that money runs out. Then you have to pick it up. And you're only charged interest on that money as it's used. So even though we're setting aside $60,000, you're not being charged interest on that $60,000. You're charged interest when we pay the $2,000 for your taxes and the $1,800 for your homeowners insurance or whatever the fees are. That's when it gets hit. That's when it hits your account, and that's when you get charged interest on it from day one. So it allows you to get a fixed rate without giving up all the money. Now, if we had to set aside $100,000 and you only had $80,000 left over, then you'd have to say, okay, well, I'm willing to only take $100,000. There's $200,000 available total. $100,000 has to be set aside to pay your taxes and insurance. If you're 62 and you live in a really nice home and the taxes are $5,000 a year or something, it could be over $100,000 that we have to set aside for the next 20 years. So that's kind of how that works. That's a way around using the fixed rate limitations. Okay, but let's now dig into the adjustable rate. There's subtle differences between the monthly adjustable and the annual adjustable. But first, I want to explain all the payment options are available to you with the adjustable rate, regardless of which one you choose. Okay, closing costs don't change. Closing costs don't change on any of these interest rate products. You could choose any of these products. The only thing that might change, depending upon lender pricing, is, depending on how much we might have to charge a higher origination fee for different products. Okay, because what happens is these loans, just like every other mortgage in the industry, they get bundled together. Okay, and then they're sold with their mortgage-backed securities. These are called HMBS. For HECM mortgage-backed securities. And depending on what the market is willing to pay for a fixed rate loan compared to an adjustable rate loan, or compared to an annually adjustable rate loan to a monthly adjustable rate loan, sometimes those costs can vary slightly. Not very often, but sometimes they do. Okay? But what happens then is you can In that situation, you own your home free and clear. You have $200,000 available. You say, I only want to take $25,000 for some home improvements. I want to leave the rest in a line of credit. You can do that with an adjustable rate, either annual or monthly. It doesn't matter. You can also say, well, I want to take a monthly payment of $500 a month, and for as long as I live in the home, and whatever money is left over, leave in a line of credit that I could use for in emergencies. You can do that as long as there's enough money. I think you would, even with somebody that's 62, you could probably receive enough money to, if you've got $175,000 to set aside for that, we could pay you $500 a month. There's no guarantee, but the $500 a month, if you have enough money to do that, that's guaranteed as long as you live in the home. You could live there to be 108, and 150 actually is when the loan comes due. The youngest homeowner's 150th birthday is when the reverse mortgage loan actually comes due. Most people leave the home before then. Either they pass away or they sell the home or something like that. But you can do that. That option's available to you with the adjustable rate. It is not available to you on a fixed rate. You could do any combination. You could do a term payment. Say you want $5,000 a month for the next 6 years to be able to make up that gap for you're waiting to draw Social Security. Well, we can do that as long as there's enough money to set aside to pay you that. So it's very, very flexible. And leaving money in the line of credit has a ton of benefits as well, because you can allow that line of credit to grow over time. You don't need the money now, so you just leave it sitting there. And it grows at 0.5% greater than the interest rate you're charged. If you're being charged 7.25% interest on the reverse mortgage, the line of credit will grow at 7.75%. That's why some people will pay into their loan. They make payments on a reverse mortgage because it lowers the loan balance. You're charged less interest because the balance is lower, and that money that you paid into it is still available to you in the form of the line of credit. It gets added to the line of credit. The growth rate on the line of credit is not interest. You're not earning interest. We're increasing the amount of money you can borrow from the equity in your home. You're increasing the amount of equity by making payments on your reverse mortgage. Now, you can make payments on a fixed rate reverse mortgage as well. Okay, don't get me wrong there. There are people who do that, but once you pay into that loan, that money is not available to you later. Just like if you had a fixed rate forward mortgage and you pay an extra $1,000 a month, you're reducing your loan balance faster, but that money's not available to you at a later date. Now, if you had a traditional HELOC loan, a home equity line of credit from your bank, and you pay an extra $1,000 one month, well, that $1,000 is available to you in the line of credit. It's an adjustable rate, though. So all revolving lines of credit, even credit cards, are adjustable rates, because a lender's not willing to make money available to you in the future down the road on an adjustable rate, because if rates go up, now you're drawing money at 5% when the rates are at 7%. That's a hell of a deal for you, but it's not for them. And the bankers always make it more favorable to them than you. That's the way the banking world works, right? If you do any research on history, go back to J.P. Morgan or even the Rothschilds, whatever, you could see that they're in it for profit. And that's how they make a profit, is by charging you interest on the money that they're loaning you, because reverse mortgages are a loan against your home. Okay, so you've got all those different options available to you with the adjustable rate. The only option available to you for a payout on a fixed rate is one time, one lump sum. You can take money as a lump sum also as an adjustable rate too. Don't forget that. There's people who, I have just enough money to pay off their existing mortgage, but they still want an adjustable rate because it's at a lower interest rate, which means that we can loan you more money. You get more money at a lower rate right now. So that's why people do that. A couple differences that I want to touch on between the monthly adjustable and the annually adjustable. The monthly adjustable rate has something called, well, they both have caps, whether it's adjustable monthly or annually. They both have caps. They have a 5% interest rate cap. the interest rate can never increase by more than 5% above the start rate. If you're starting right now at 7%, the interest rate's 7%, the interest rate can never go above 12%. Depending upon the margin, it can never go below typically 2.5%, sometimes 2.25%, depending. So it's going to be in that range, say of 12% or 2.5%. Your interest rate will always be there. But every month, when you get a statement in the mail or you look at it online, you're going to see those adjustments happening. It'll say next month your interest rate's going to drop from 7.123 to 7.015 or whatever the case may be, or it goes up by. Usually it's fractions of a fraction. I mean, it's a tiny percentage every month, most of the time. So, but that's the most it could ever go up on the monthly adjustable is 5%. It could theoretically increase, say, from 7% to 12% in 1 month on the monthly adjustable. Can never go above that. On the annual adjustable, it's got annual caps as well as a lifetime cap. The lifetime cap is that same 5%, but then it can never change by more than 2% per year. Up or down. That's the problem. Now, let's say you say, I got to have an adjustable rate. Well, number one, the interest rate's about a point higher on the adjustable rate. That's just what the market is. Right now, the market, investors don't want to pay for those mortgage-backed securities that we talked about before on an annually adjustable rate as much as they want to pay for a monthly adjustable rate. So the interest rate's higher. That means you get less money on the annually adjustable rate. But if the rate goes up by 3% this year, you get it at 7 and it goes up to 10, okay, and let's say it did that right after you took out the loan. You're sitting at 7 even though the rates are at 10. But then next year when your rate adjusts, it'll adjust to 8. But then let's say that 10% drops down to 6%. You're sitting at 8% for the next 12 months. And then when it does come down, it's only going to drop down to 6%. Okay, if the rate drops again, you're sitting there. So you have to wait for those changes to occur. That's the downside. Number one is the interest rate's higher on an annually adjustable rate. So the money you qualify for is less, but then you can't take advantage of the rates. Now, sometimes there's a disadvantage too, so it goes both ways. It's a double-edged sword. But either way, call me with any questions. I'd love to talk to you about your specific situation. We could talk about these different options. My number is 303-513-2748. 303-513-2748. Actually, I just gave you my cell phone number. I usually wait until you call me first because this gets out on public airways and it's on all different kinds of media. I don't typically like to put my cell number out. My main number is 303-467-7821. 303-467-7821. Just between you and me, you can call me on either one, okay? But you can also visit me online at at reversemortgageradio.net. Now I'm all flustered. Call me or visit me online at reversemortgageradio.net. I look forward to talking with you. I hope you have a fantastic day, and thanks for listening to Reverse Mortgage Radio.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821 or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.